Let's get started talking about how to trade triangle chart patterns like a champ. Now, chart patterns are well documented in technical analysis literature and are based on the psychological phenomena that occur between buyers and sellers of financial instruments in liquid markets. Pattern formations do not form a trading system, but rather provide an indication of the future trend of an asset as the price breaks key psychological barriers in the form of support and resistance. So I am sure you've heard about chart patterns for online trading and their relation to technical analysis. You probably know about double tops and double bottoms, triple tops, triple bottoms, head and shoulders, rectangles, cups and saucers. You probably heard of them all. We have flags and pennants. But let's go over first and let me show you what market structure looks like. Okay, so for those of you who don't know, we'll make sure you do get them. Okay. So here on this chart, I've actually put together for you all the major what we call market structures or patterns. Starting from the left, you can see we have a bull pennant. We there go to an ascending wedge, then a descending wedge, a triple top, a bear flag, and a bear pennant. Okay, and we're just starting over on the left. So we're here to here to here to here to here to here. Now, I personally, and this is just me, okay, I lumped most of these into what I call triangles. A bull pennant to me is a triangle. An ascending wedge is a triangle. There are slight variations, slight explanations. A symmetrical triangle has support and resistance lines on the same angle. An ascending wedge is pointing upward, and the two lines, the support and resistance, are on slightly different angles. Same thing with the descending wedge. Okay, a bear pennant, okay, looks like a symmetrical triangle. And we have asymmetrical triangles and descending triangles, depending on which way they are pointing. Then we have the cup and shoulder, the cup and handle, and the inverted cup and handle. And then we have the famous head and shoulders and the inverted head and shoulders. This is primarily all of those patterns, but most of them I lump into, from my interpretation, of triangles. I don't try to separate all the different kinds of triangles, okay, because they don't give you any more information memorizing all their names. They all have some general rules, but they're mostly common sense rules about the angles of the support and resistance lines. And these are called support and resistance because in an uptrend, let's find an easy one in an uptrend. This is moving in an uptrend. So the support line is the line underneath price, and the line above price is the resistance line. Okay. No different than support and resistance in trend lines. Support and resistance, when you're finding support and resistance levels, they are lines above and below the pattern. Now, how you find the pattern is a different story. We'll come to that. Now, you can see on here I've located a head and shoulders, inverted head and shoulders. Well, a head and shoulders is quite famous. Okay, it's really a very reliable pattern, except for us who are trading in small increments of time. A head and shoulders takes a long time to develop, and it takes a lot of time to see it. And for us trading CFDs, it's not really appropriate. It doesn't help us much because it takes up lots of candles. Okay, so I don't waste my time on it because it doesn't fit my trading. Okay. Now here we have a well-developed triangle. And these are just giving you examples. We'll come back and learn how to put these on here. But here's our, well, we can see price is moving in a general uptrend. So the line underneath would be our support line, The price over top of the candles would be the resistance line. We have the difference between the support and resistance at the beginning of the triangle pattern. And we have what's called a breakout here, and a breakout here, which we'll talk about shortly. And this is referred to here as the apex. It's where the two lines converge and price is really being pushed into that apex. And I'm just telling you all this now because I want you to understand basically what we're talking about, so you're not sitting there lost as I give you a lot of words. We're going to go back to all this and you'll learn it all, but just so you have something in your minds about what I'm talking about. So, if you're like me, I believe that price is completely random. Okay? Because price of an asset is dictated by the psychological makeup of the buyers and the sellers. And nobody can actually predict where price is going to be anytime because it's just completely random. But there are certain times during this random movement in the markets that there's small frequencies of non-random movement. Okay. Sometimes these are called trends. Okay. Sometimes this non-random movement fits into a pattern. When we can discern a pattern or a trend, these are small periods of non-random movement that will let us form trading or make good evaluations of the market. So in order to have a complete understanding of chart pattern trading, we should also gain a good understanding of the most common on-chart formations, which we looked at. What I'm referring to are triangle trading patterns. So in this webinar, we will discuss the basic triangle formation and some ways to properly identify and trade these formations. So a triangle pattern is a specific figure formed on a price chart, typically identified when the tops and the bottoms of price action are moving towards each other like the sides of a triangle. When the upper and the lower level of these triangles intersect, traders expect an eventual breakout of that triangle. As such, many breakout traders use triangle formations to identify breakout entry points. Now, there is no law, there's no rule, there's no guarantee that price, even when you see the formation of a candle, is going to go all the way into this apex. We're just watching price as it moves in. And what we're seeing is a pent up, the buyers and sellers are getting pent up into a smaller and smaller price range. Because in a symmetrical triangle is when the support and resistance level lines are on basically equal degrees. Okay, so what we have is the lows are getting higher and the highs are getting lower as the market constricts. Now, price could break out here. Price could break out here. Now, on the whole, triangles do not really give us any directional clue. So you can't see a symmetrical triangle and say price is going to go up, or see a symmetrical triangle and say price is going to go down. Doesn't work. What we do know is if price gets forced closer and closer to this apex, it's got to break out at some given time. Okay. When we get that breakout, we can then make some determinations. Now, there are different kinds of triangles that can be seen on a price chart. Before you jump into triangle trading, you should understand the difference between the formations. We will now take a closer look at the various triangle patterns and the corresponding trade setups. Once you are equipped with this knowledge, you should be able to add a triangle trading strategy to your trading arsenal. Now, the most prevalent one, and the ones we've been talking about, is a symmetrical triangle. A symmetrical triangle is a situation on a chart where the tops of the price action are lower and the bottoms are higher. Now, for everything we talk about tonight, there is a mirror. For a ascending triangle, there's a descending triangle. And the rules are just reversed because one's coming off of a downtrend, the other's coming off of an uptrend. When we have a symmetrical triangle, like here that's developed, the rules just flip over if it's coming off of an uptrend or a downtrend. But there are rules that apply to all of them. Now, we have the apex here. We have the width of the triangle from where it first began. This is very crucially important because the width of this triangle is also used for when we get a confirmed breakout for where the momentum would carry us, so where you would set your target price when you are buying or selling the asset. Now, since we don't know a direction, it can be that target price, this width, either up or down. But this is a standard interpretation of trading the pattern. So typically with a symmetrical triangle pattern, the expected breakout is unknown. The reason for this is that the bullish and the bearish move have equal strength as seen through the price action. When the breakout occurs, it will likely to provoke a price move equal to the size of the pattern. Now, this is not something I'm making up or using for our presentation. This is a generally accepted rule of the marketplace. Therefore, you should carefully identify a potential breakout in the upper or the lower level of the symmetrical triangle in order to take the right position in the market. Now, as you can see from the example, the potential target is based on the size of the triangle formation. With this type of measured move analysis, you will know what to expect for a symmetrical triangle breakout, whether it breaks upward or downward. And this same pattern, or these same dimensions, apply to an ascending and descending triangle. So here we have an ascending and a descending. I just simply call them all triangles. The difference is between a symmetrical triangle, remember the symmetrical triangle, you had a support and resistance line both on the same angular degrees converging together. With the ascending triangle, an ascending triangle is normally found during an uptrend, and what you end up getting is a angular support line and a horizontal resistance line. So one line slopes while the other one stays horizontal. In a descending triangle, which usually comes off of a downtrend, you get a horizontal line and one sloping line. You would still measure the width of this move here, the width of this move here, and the apex is still the same here. So these types of triangles have one flat horizontal side and one sloping side, which is moving towards the flat horizontal side. The ascending and descending triangles are mirror images of each other. They are identified as ascending and descending depending on which side is the horizontal side and which side the slope is on. Now the triangle pattern has its upper side flat and a lower one ascending. So if you want to memorize his names, ascending means what? Moving up. Descending means moving down. And that's what you see in the triangle, not the price and not the breakout, just what the price is moving while it moves into that triangle and the formation. So you can look at the ascending triangle. What's it doing? It's pointing upward. The descending triangle is pointing downward. Now, in this example, the black lines above indicate the price action within the triangle formation. The blue line refers to the side of the triangle, which is the support and resistance lines, and the red lines respond to the size of the triangle and its potential target. This potential target is usually a one-to-one measured move. When an ascending triangle is formed during a bullish trend, we expect a continuation pattern trend. In other words, when you get the triangle and the price is moving up, we would expect, not that we will, we would expect or we would predict a bullish move because the price has been moving in an uptrend and we would expect it to continue on in an uptrend. Because remember, whether a price is moving an uptrend or a downtrend, when those trends begin, they're likely to continue because the momentum's in the market. So that's why we would look at it as a bullish trend, but not that we're going to make a buy or a sell decision because we have no idea where the break is going to occur and what the break is going to tell us. So it's only what's in your heart at the moment. You're feeling bullish when you look at that. Not that you're going to buy, it's because the price has been moving in an uptrend and therefore is bullish. Now, it's very important to mention that the ascending and descending triangles sometimes break through the incline level, causing false signals and trapping some traders along the way. The same holds true for the horizontal price zone. You should always wait for the close of the candle to confirm the breakout. This will help reduce many false signals. Okay, and it's important. Too many traders, let's go back to my charts, see, and there's a lot of people that trade by the rule that says when the candle breaks out of the pattern, you should jump in and buy at the completion of the formation of that candle. Okay. That is a very risky, very iffy proposition. I say you always need to wait for the third candle to tell the final story. If you're looking for this much of a move, in this case, the upward, okay, do we need to get into trade here? No, we can get into trade here and still make profit. And if you notice in this trade, you would have lost your shirt because this was a false breakout. And you get this quite often. Now, one of the telling signs is also volume. Okay, here we got the breakout, but we didn't see any increase in volume. If you want to believe that this was a breakout and it was going to take you all the way up to here, we should have seen increased buying, but we didn't. Now, as price moved back into triangle, which it normally does, because it was a false breakout, at this point we were forced farther in the apex, and now we broke out here. Here, and at this point, we could have entered this trade. Now, this is a current live chart. So as you can see, the price is still continuing down. So if you would have entered here at the third candle, you would have made, at this point, sitting pretty on profits, but we would still be expecting it to come down this far. But as price started to decline, look at the increase in selling. We saw a lot of increased movement in volume. So we had waited for the third candle, and we got our right signal in the right direction, doing the right thing. So pennants on a chart have similar shapes to the symmetrical triangle. They typically appear during trends and have a trend continuation character. Therefore, I just call them all triangles. A bullish pennant is similar to a symmetrical triangle in appearance. Okay. Now, here is the, I don't even know how to say, I'm going to say a bunch of crock, but it doesn't really make a difference. A lot of traders, a lot of gurus out there have tried to come up and say, they've tried to somehow or another incorporate the Fibonacci level and say that the second target point is 0.618 of the leg could be used. Okay. So they say set 2 target points. Here and here. I say, I have no idea where this is. I don't use it. I don't know who even came up with the idea and why they're trying to combine a Fibonacci number into figuring the target. My sensible target is here. The width of the triangle, standard rules, and if it does better, I'm really happy. But I prepared for here because you need to remember, you need to be able to use a target point to set your risk-reward ratio for your risk management. Now, remember, for bullish pennant, you have bearish pennant. What are they referred to? Whether they're coming available in a uptrend or a downtrend. So what do we have? We have symmetrical triangles, we have rising wedges, we have symmetrical triangles, we have bearish pennants, and bullish wedges. They're all the same thing. They're all form some sort of a triangle formation. They all have the same basic rules. Okay. Now, as I said before, if price is coming off of an uptrend, we might have a bullish feeling, but that does not tell us anything because this pattern could have broken out just as easily that way. Okay, here we have a symmetrical triangle coming off of a downtrend, and it continued down because when we're trending, the overall chance of continuing in that direction is follow the rule. The trend is your friend. But I'm going to take you over here, and I'm going to show you, because we studied 525 patterns on different assets, okay, to see how reliable all of this bullish continuation, bearish continuation is. And guess what? Not so good. If we were to use a 4-hour time frame, we would find only 61.5% in the Canadian dollar was correct. 57% in bullish was correct. But in the USD JPY, we only had a 33 and a 40%. That was simply deciding to trade up in a bullish continuation or trade down in a bearish continuation. Okay. Overall, it only gives you a 54% success rate because you're basically at that point blindlessly guessing. Now, if we were to move it over to a 1-hour chart, it's even worse. So this is why you don't see, and this is why I say, pay no attention to ascending, descending, symmetrical, rising wedge, falling wedge. You will see the pattern. You need to wait for the breakout. When you get the breakout, not estimating what you think it will be, when you get the breakout, if you confirm it on the third candle, and you can see an increase in volume, you've moved your 51.7 success rate to about a 75% success rate. Well, that's pretty dang good. So in this test, there were a total of 525 patterns on all charts over the period investigated. The pattern was correct in predicting the continuation in just 52% of the case. Well, if we were in Las Vegas and we were the house and we just wanted to rake in 2% on every dollar wagered, well, that's an acceptable odds. But when you're wagering everything and you're the wager or you're the trader, you don't want to wage or bet. You want the odds in your favor. Okay. So we won't make a decision based on an ascending triangle being a bullish continuation, a descending triangle being a bear. We are going to wait for specific rules to take place. And even though the numbers are quite small, this does give objective data on the reliability of the symmetrical triangle across Forex pairs. When the pattern ends, the volatility dips to a minimum, as support and resistance lines will be very close. The market will then usually start to show some preferred direction. There's no guarantee of this, however. As always, it's best to prepare for false breakouts and retest the support and resistance lines. So the easiest way to trade this chart pattern is to treat it as a continuation breakout. Okay. Here, just wait for a clear break above the resistance line in a bullish trend, or wait for a clear break below the support line in a bear. You need that 3 candles volume. So while there are instances when symmetrical triangles mark important trend reversals, they more often mark a continuation of the current trend. Regardless of the nature of the pattern, continuation reversal, the direction of the next major move can only be determined after a valid breakout. So we want to increase our success rate by, number 1, looking at the trend. And a good way to do this also is to have your trend line on a chart, because if that pattern stays within your trend line and your trend line is still holding good, then most likely it's going to stay above the trend line. We want to look at volume. As the triangle extends and trading ranges contract, volume should start to diminish. This refers to the quiet before the storm, or the tightening consolidation before the breakout. A breakout should be on the closing basis of it to be considered valid. Some traders apply a price or a time filter to confirm validity. And that's why I said 3 candles. That's what we're trading in a 15-minute or 1-hour chart for our type of trading. So after the breakout, the apex can turn into future support and resistance lines. The price sometimes returns to the apex or a support and resistance level around the breakout before resuming in the direction of the breakout. There are 2 methods to estimate the extent of the move after the breakout. First, the widest distance of the symmetrical triangle can be measured and applied to the breakout point. Second, a trend line can be drawn parallel to the pattern's trend line that slopes up or down in the direction of the break. So to sum it up, triangle patterns are easy to spot and provide good risk-reward opportunities. Traders can quickly know that a big move may be near, as well as a profit objective and the amount to be put at risk. Now that you have the knowledge of these 3 powerful price patterns, you are steps closer to becoming a more confident trader. So thank you very much for joining us tonight. And thank you for supporting ETX. And we'll talk to you again next week. And try out triangles. Put them on the ETX charts, test them, learn from them, and you'll see in no time at all, you'll be able to spot them, trade them, and put them into your trading easily. So have a great night, and we'll talk to you on Thursday. Good night now.